So then let's start the session, guys. So we are actually in the financial accounting session. As you know, we have covered this introduction to accounting, and still we have to see the past papers. As per the learning outcomes, you have to know the identify the importance of financial accounting, the objectives, the accounting process, environmental factors. So like that, and in the chapter two, I have covered about identify the business transaction of business entity, explain the accounting equation, and we have to apply the effects of business transaction on the accounting equation. Actually, we will achieve these learning outcomes when we are going to do the past papers, right? When we did past papers, then we will achieve these, apply the accounting principles, everything. So now we are actually covering these explain accounting concepts theory, right? So we will in the accounting concepts theory, since we have covered the elements and basic accounting equation, the double entry systems. In the accounting concept, my dears, I have covered two concepts in the previous sessions that are the first one is about going concern. As you know, the going concern in the sense we are going to continue our business operation for the foreseeable futures. Future foreseeable futures means unlimited lifetime, right? So we are assuming that there is no closure of our business or there is no risk for our business to shut down our business. That is going concern. As well as this is the assumption, basic assumption of preparing financial statement is going concern. Without going concern assumption, we cannot produce any financial statements because we cannot classify the assets as a current as non-current assets or liabilities as non-current liabilities as current liability. So if we have going concern only, we can classify the assets. So that's the very basics, right? So we are categorizing the assets of the entity as a current assets and non-current assets based on this assumption. If we are following the assumption only, as well as categorizing the liability as a current and non-current liability based on this concept, as well as we are disclosing the liabilities in the finance statements at cost instead of their realizable value, right? Instead of the actual market value of the particular assets or liabilities, we are considering the liabilities also the assets in their cost value. It means we have purchased some assets before 10 years or 11 years ago, but still we are realizing that in the that particular account, because we are not going to sell that asset, we are not going to close our business, right? As well as we are depreciating our property, plant, and equipment annually. That also we are going to, you know, run our business for a long period of time. So we are categorizing that as a annual depreciation because we are going to use that asset for more than 12 periods, more than 12 months, more than 12 years, right? So these are the going concern concept I have studied, right? As well as I told you in the previous session. As well as, we have concern on this periodic concept also. As you know, while an entity is assumed to be a going concern, right? We are assuming an entity, it must have a going concern. It means it has to run his operations for a foreseeable business, but it would be impractical. We cannot wait until we finish 50 years, 60 years of lifetime achievement of the business, right? So it would be impractical to wait until the end of its life to ascertain its performance. Performance in the sense, I'm talking about the profit and loss. Always the performance of the business or the operational result is profit or loss. The periodic concept addresses this by dividing the unforeseeable future of the business into periods. Generally, we are preparing statements for a year. So we are dividing the unforeseeable future, that is from the going concern concept, and we are dividing into periods. That's called accounting year or accounting period. And for that period, we are measuring the performance. Performance in the sense profit or loss. As well as we are calculating the financial position. Financial position is always the assets, liabilities, and equities at the particular date. As well as we are calculating the changes in cash flows. It means in the year beginning, how much cash we can, and the year end, how much cash we are having right now, and what has happened until that period, from the beginning to end, what has happened, right? So this is periodic concept. So why we are where we are applying this periodic concept is we are stating in the financial period. It means the actual year in the header of the income statement. We will mention, okay, this is an income statement for this particular company for the period of 31st March 2029, 2025, 26. So We are planning this periodic concept, then only we are considering this particular period we have prepared this. As well as we will state at the financial position, okay, we have prepared this financial position as at the date in the header of the statement of financial position. Normally, we are preparing the financial position for that particular date. It means as at 31st December or 31st March, at that particular date, what are the assets we are having, the value of the asset, the value of the liabilities, the value of the owner's stake in the business, right? As well as we are considering the income and expenses relevant to the particular year. We are not going to include any income or expenses that is represent the next year, as well as we are not going to include any income or expenses that is relevant to the previous year. We are actually going to care only the expenses and the income that is only relevant to the particular year we are preparing the income statement. So these are the application of periodic concept. I have discussed this in the previous session as well. Now let's talk about this accrual concept, my dears, right? So this accrual concept means we record income and expenses, right? We record income and expenses in the period they relate to. If it is related to 2025, let's say from starting period to April to March, April 2025 to March 26. So we record that income as well as expenses in the period they relate to, not when cash is actually received or not when cash is actually paid. If you earn the income, you record this for that particular year. If the expenses are incurred for that particular year, you record for that year. Even if the cash comes next year or we have received the cash in the previous, it doesn't matter. We have to record the income and expenses that is relevant to that particular year, not accordingly the cash received or not, right? So let's consider this concept, my dears. The accrual concept states that all income and expenses are recognized for the periods which they relate to, right? For the periods which they relate to. We are ignoring whether the cash is received or paid, right? Whether we have received the cash for the income or we paid the cash for the expenses, it doesn't matter when preparing the statements. We are considering whether that particular income is relevant to that particular year or the expense is incurred that is relevant to that particular year, right? So according to that only we will have some adjustments. Actually, I will explain how to do these adjustments when we be preparing the financial statements, right? So we will have prepaid expenses, accrued expenses, income receivables, as well as this income received in advance. These are some accounts as well as some adjustments we will do. Prepaid expenses, right? We have paid the expenses before it occurred or before it incurred. As well as accrued expenses means the expenses are incurred, but actually we didn't pay in terms of money. Accrued expenses. As well as income receivables means we actually earned the income, but not we have received the cash for that particular. And income received in advance means we didn't earn the income, but we have received the advance. So these kind of adjustments we have to do because of the accrual concept we are having in accounting. So let's talk about these prepaid expenses later, my dears. So accrual concept is the adjustments of accrual basis actually, as well as accrued base expenses also. It incurred. We will record that as a current liability because already the expenses incurred. Let's say you have received the electricity bill but not yet paid. That is an accrued expenses, right? So income receivables, let's say trade receivable is a type of income receivables because you delivered the goods or services to the customers but not yet you receive the payment, right? Actual cash. So the income receivable. So accounts receivable or the trade receivable is one of the type of income receivable. Let's say, you have given your building to the rent, the month is passed, but you didn't receive the money yet. So that is income receivable, rent income receivables. As well as income received in advance, like you didn't sell your goods or you didn't deliver your goods to the customers, but actually you received an advance from that particular customer for the next year or next month sale. So these are the adjustments required. We will discuss this each and everything when we are doing questions as well as and some examples, not now. Okay. Now the concept is simple. We have to record the income and expenses that is actually relate to the year, not according to the cash received or cash paid. We are not considering when we are paying the cash or when we are receiving the cash, but the income should be earned for that particular year. The expense should be incurred for that particular year. So how we are applying here? We are considering only income and expenses of the period to which they relate when preparing financial statements. So when we are preparing financial statements, if the expenses related to the previous year, we will remove it. Right? There are some expenses adjustments like that. We will learn about that later. As well as prepaid expenses and income receivables, right? So prepaid expenses and income receivables are recognized as the current assets, right? Let me highlight this word for you, my dears. This prepaid expenses. Prepaid expenses means before we incur the expenses, we actually paid advance for that expenses, right? As well as income receivables means, we actually delivered the goods or we actually performed the services, but we didn't receive the money yet. So prepaid expenses. Before the expense, we paid the money. Income receivables means we earned the income but not yet receive the cash. So these are recognized as a current assets. These two, prepaid expenses as well as these income receivables, we consider as a current assets. At the same time, while accrued expenses means the expenses incurred but not yet paid as a cash now, as well as pre-received income. We didn't perform the service, we didn't deliver the goods, but we received the advance for that incomes are recognized as a current liabilities. Very important point, okay? So prepaid expenses and income received are assets because we deserve it, right? But accrued expenses and pre-received income, we are categorizing as a current liability. So please understand this. So you will get more understanding and more calculation basis when we are doing the questions. As well as there are other categories like prepaid expenses, right? And they are adjusted. So, prepaid expenses, accrued expenses, income receivable, pre-received income. So these are adjusted when ascertain the financial performance, right? Because when we are calculating the profit or losses, we have to adjust the particular income. If we have, income receivable or pre-received income for that particular income type, or if we have prepaid expenses, accrued expenses for that particular expense type, we have to adjust. So that's the application of accrual concept. As well as we are recognizing of the trade receivables and trade payables because of this accrual concept. Trade receivables, that is a kind of assets, no? Current assets. How we are recognizing? Because of the accrual concept. Since we didn't receive the money yet from the trade receivable, but still they are the assets of the company. So we are recognizing the income as well as recording the trade receivable as an asset because we are following the accrual concept. As well as let's say we are recognizing the trade payables. It means we didn't pay the money yet, but purchases we are recording as an expenses in the income statements, right? Purchase account. Why? Because it's incurred but not yet paid as a cash, but still is a type of expenses, right? So that's the applications, my dears, right? So I hope so you understood the accrual concepts means we have to do the adjustments that is necessary to keep the expenses and incomes that is only relevant to the particular year we have a concern in preparing financial statements, right? I hope so you are getting my point. And let's talk about the prudence concept. We call it as a conservatism concept. So prudence, it means, my dears, the concept prudence means it's like you have to be very careful. That is prudence. So it's like don't be overly optimistic in accounting. Don't be overly optimistic. If there is a chance of loss, it's going to happen in the near future. Provide for it now. Record that as an expense now. Don't wait until we lose something. Record a provision for that. But if there is a chance of profit, wait until it actually happens. This prevents businesses from overstating their financial health. So simple, my dears. There is a probability that in the near future there will be a chance of loss. Please provide expenses and make it current liability now. But if there is a chance of making profit in the near future, please wait until it actually happens, then only please record. So that is prudence concept, my dears. Let's talk about in terms of definition here. The prudence concept states that if risk of future losses exist, right? If there is a risk of future loss, I'm highlighting the word future. The loss is going to happen in the near future after 6 months, after 7 months, after 3 months. So we have to provide the provisions. Provisions means we have to record the expense for the future losses now, and we have to record it as a current liability. So if there is a future losses exist from your risk estimation, you should provide provisions from the current profit, even if it is not incurred at, right? Sometimes it is not going to happen, the loss, but still you have to reduce your profit from now by giving provisions as well as expenses. However, if there is a future profits, it means you know you are going to make some profits, but not recorded until they are realized. So you are very prudent, you are very careful. If there is a loss, you are recording and reducing the profit now. It's going to happen in the near future. But in the near future, if you are going to receive some profits, you are not going to record it until you realize. So this will ensure the accounting records are do not overstate. Overstate means they are not giving higher numbers. Receive a profit, don't record. But if you are going to make a loss, please record it now. Simple. That is prudent. Be very careful. We don't need to overstate our profit, but we can underestimate our profit. That's better. That's prudent concept. So let's say one practical example for you. Let's say Hazan. Okay, Hazan runs a furniture shop in Goal area. So he sold a furniture worth of rupees 100,000 to a customer for the credit. But he hears that the customer's business is struggling now. Even though the customer has not said they are not going to pay, they are going to have some bankruptcy in their business. But now you heard about that news. You know from that 100,000 worth of credit sale, you are going to incur at least a 10,000 as an irrecoverable debt. We call it that as a bad debt. It means from that 100,000 credit sale, you are estimating that you are not going to receive 10,000 in the near future. But Hazan, he didn't say that, right? But you know the loss is going to happen. So you are creating a provision for the doubtful debts. There is an expense. So you are going to reduce your profit by giving an expense, okay, doubtful debt or irrecoverable debt. And you are recording that as a distribution expense in the income statement. You are reducing the 10,000 profit from the current profit, right? However, Hassan is negotiating sometime big order for his business, and he might bring like say let's say 500,000 profit for the next month. But following a prudence concept, right? You know, you are not going to record this 500,000 profit until the deal is confirmed and completed. So I set two examples. The first example, he is going to incur 10,000 loss, but he is recording right now and he is reducing the current profit. But he is going to make 500,000 profit in the next month, but he's following the prudence concept. He's not going to record this 500,000 of profit right now until the deal is confirmed and completed. That is prudence concept. You got the point? So let's see how we are applying this concept in the real life of accounting. The first one is we are making provisions for doubtful debts. Doubtful debts means, my dears, we had a credit sales, but for some portion, let's say in our previous example, 100,000, we made a credit sales, but we have a doubt we are not going to receive 10,000 from that 100,000. So we are going to reduce the profit by giving an expense 10,000 and we are giving a provision like current liability 10,000. So making provision for the doubtful debts, it's according to this, right, concept. As well as we are doing some depreciating non-current assets. We are depreciating the non-current assets because we are going to incur some expenses, right? When we are depreciating our company's car, we know we are using that, so the value is decreasing. After the 10 years or 15 years, we have to replace that asset, so we will have another expenses. So we are depreciating non-current assets and we are providing provision for that, right? That is based on this prudence concept. As well as We are excluding the sales value of unsold goods sent on a sale or return based condition. We are excluding the sales value of unsold goods. It means, my dear, sometimes in our business, you know, we will sell to some agents in the basis of sell or return basis. It means what? We are not actually selling our goods to them. We are just changing the location of the goods to another warehouses, another agent. But still, the owner of the goods are the same company it's issuing, right? When the particular agent is selling to the outside people only, we can record that as a sales revenue is recognized. So it's prudent, right? Just changing the location of the goods from our warehouse to our agent house means there is no sale. It's changing the location. So we cannot include under the sales. Just shifting the location from our location to the another agent location. He's just keeping the assets or the inventory behalf of us. If there is no sales from the agent to the external party, we cannot recognize that sales. So we are excluding the sales value of unsold goods sent on a sell or return basis. Please try to sell within this particular period. Otherwise, please return to us. That is not actual sales because we are following the prudent concept, right? As well as we are recording the inventory at the lower value of cost or net realizable values, right? We will learn this in the LKS2 also. My dears, the lower of cost or net realizable value means simply, let's say you purchased a good worth of 100,000 rupees. But now you can sell in the actual market only for 75,000 rupees. Now the assumption, the prudence concept is saying, please record the inventory at the lower of the cost or net realizable value. Net realizable value means the value you can actually sell in the current market because of the demand and supply. That is market price. But the cost, it might be higher than the market price or lower than the market price. So let's say you paid actually 100,000, but you can sell it only for 75,000 now. So the cost is 100,000, the net realizable value NRV is only 75,000. So we have to record it in this 75,000 only as an inventory value in the current asset in the financial position. You have to provide 25,000 as a you know inventory written down value or inventory market value loss something. So these are according to the prudent concept. It means if we are going to make some losses, we have to record it now. If we are going to make some profit, we cannot record that until we earn that profit. That is simply a prudence, conservatism. It means we are very careful with recognizing our income as well as providing expenses. Right? Did you get the idea of this prudence concept very well? So now let's talk about the consistency concept. I'm always talking about consistency. Please be consistent, right? Let's say if no one is joining the class, even I will record the class and I will take the class, I will record it and I'll provide the video for the students. That is consistency, right? That is consistency, my dear. Like that. Once you choose an accounting method or once you choose any accounting policy, please stick with it for a year after year and after year. Don't keep changing the accounting methods because it is, if you are changing the accounting methods and accounting policies very frequently, it makes it impossible to compare 1 year's results with another because for 1 year you are having another accounting method, there is a separate accounting procedures, but another year you are using another accounting policies, accounting procedures, accounting methods, so you cannot compare, right? That's what the consistency policy says. This concept states that the basis, the methods, the principles we use to in preparing and presenting the financial statement should be applied consistently from one period to the next. So the basis, methods, principles, right, whatever, the accounting policies we are using, we should be applied consistently from one period to the next year. We can't change it without proper reasons, right? Let's say Mariam owns a bookshop in Kandy. So she uses a method called FIFO. We will learn about this, right? We will learn about FIFO method, LIFO method, FCO method in inventory valuation in LKS2 in future lessons, but not for this particular level. So she is using the FIFO method, like first in, first out method to value the inventory, right? So in 2023, let's say her closing inventory is around 150,000. using FIFO method. So she must use the FIFO method in 2024, 2025, and also for the future years. Why? She can't suddenly switch to any other FCOV or average cost method, because it will show higher profits than this year, because that method native is like that, right? But however, if a new accounting standard requires any change, there's a new accounting standard is coming, and it is released by the C Sri Lanka or any other international bodies, that standard is requiring you have to change. So if the new method is providing more reliable information, so you can change, but you must disclose, okay, we had a change in this particular accounting policy as a notes in the financial statements, right? So that is consistency. Let's say an application is here, selecting an inventory valuation method, as I said, FIFO or weighted average cost, and continuing use it. That's important. You are going to use it for several years continuously without changing it. Then only you can compare the last year's performance from this year's, as well as from the another company's accounting records with your accounting records, because they are also following the same method, no? As I said earlier, there is a changes in accounting policies are allowed. When there is a changing in accounting policies or method is allowed in these two situations only. The worst first situation is to comply with a new accounting standards. As I mentioned earlier, the Institute of Chartered Accountants of Sri Lanka, they are releasing a new standard, and they are requiring a new method to follow all the accounting bodies, right? So then we can change. There is no restrictions. As well as if the change, you are going to change your accounting policy, accounting method to one to another, if the change results in the financial statements providing more reliable and relevant information because of your accounting policy change, because of your accounting method change, it is going to give more reliable and relevant information to the decision makers, then you can change. So this is the only two situations you must know when you can change the accounting policy, my dear. So this is all about consistency concept. Continuously you have to use the same accounting policies, accounting concept without change. And there is a two instances only you can change the accounting policy. You must know it. That's an exam point area. And that is consistency concept. And okay, the sixth one also. Okay, the sixth one is not consistency concept. It is entity concept, right? It is entity concept, right? So what about entity concept? As I mentioned earlier in the previous session also, the business is treated as a separate, independent from its owners. Owners are different from the entity, from the owners, right? So business is separate from the owners, owner is separate from the business. All transaction recorded from the business point of view. If the business is incurring the expenses, we will record. If the business is making income, we will record as a business income as well as business expenses. We are not going to record, owners separate income sources into the business accounts, or owners personal expenses into the business accounts. We are not going to do. So owner is separate from the business. That is entity concept. Where we are applying this concept? Several places, my dears. I'm having few examples here for you. The first one is the business name is stated when preparing the financial statements. When we are preparing the financial statements, we are not going to mention the shareholder's name or the owner's name, right? If it is a sole proprietorship, it doesn't matter. We will mention the owner's name, because the owner's name is the same as sole proprietorship name in most cases. But sometimes they will use the brand name also. But we have to use the business name, that is when we are preparing the financial statement, because we are treating the business is separate from the owner's name. As well as we are recording the assets invested by owners as a capital of the business. The assets invested by the owners, the assets, it can be cash, or it can be any non-current assets, or it can be even inventories to sell. It is actually recorded as the owner's capital. The capital is affected by the initial investment as well as the additional investments, when the business is making profit, as well as withdrawing the money as a drawings. So, right? So recording the assets invested by owners as a capital of the business, because we are treating the owner is separate, right? We are mentioning and we are telling the owner this much only for you as an owner, right? So if we shut down the business, when you sold our assets and we are paying all the liabilities, this is the only amount you have. You can take. So we are recording the assets invested by the owners as a capital of the business, and we are showing as an owner, this is the only amount we are owing to you because of the entity concept. As well as we are recording the assets withdrawn by owners as a drawings. Why? Because we are reducing the equity when the owners are taking the money, because we are treating businesses as separate from the owners. If the owners are investing the money, we are increasing the equity or the capital. Same like that, when they are taking the money as a drawings for their personal usage or the goods for their personal usage, we will reduce the amount the business owes to them, that is equity, right? So we are recording the assets withdrawn by owners as a drawings because of we are following the entity concept. Business are separate from the owners. As well as we are paying interest to the partners who provided loans, sometimes in partnership, my dears, right? Partners are the owners of the partnership. Even when they provide loan, we will provide interest to them, because let's say we are taking some loans from bank, we have to pay the interest now because he is outside from the business. Same applicable to the owners. Even if you are an owner or partner of the business, if you provide something as a loan, not as a capital, we will provide you interest because we are treating you as a separate person from the business, right? As well as we are not considering the personal properties of the owners as a business asset when preparing the financial position. So personal properties are not the business asset, right? Because we are treating the business as separate from the owners, right? When we are preparing the accounting. But in legal point of view, my dears, as I mentioned earlier, legally, the sole proprietorship partnership are not separated from the owner, right? Owners are not paying a separate income tax for a sole proprietorship and partnership in terms of, you know, theory. But companies are separate. That's according to the law point of view. For the law point of view, the owners are not separated for sole proprietorship and partnership. But accounting, we are not classifying anything. Any business, even if it is a company, sole proprietorship, partnership, corporation, anything for accounting, we are separating businesses are separate from the owners, right? For accounting perspective. So that is entity concept, my dears. I hope so. You got a very good understanding, right? So let's say an example for entity concept, let's say Ahmad owns a pharmacy in Peta area. When he invests, let's say rupees 500,000, right? So 500,000 to start the business. So the business will record it as a capital. It means a liability the business owes to Ahmad. He is the owner. But we call that as a capital because, liabilities means it's for third parties outside. But since he is a owner, we are recording and giving a special name capital, but actually that's a liability that business owes to the owner, right? And let's say the same Ahmad, the owner, takes rupees 20,000 to pay his daughter's school fee. The business will record it as a drawings. The business will reduce, but business owes to Ahmad. It means we are going to reduce the equity or the capital. As well as, let's say Ahmad also owns a car personally, let's say worth of rupees 2 million. But this is not recorded as a business asset, no. Because it belongs to Ahmad personally, not the belongs to his pharmacy business in Peta. That's the entity concept. And let's talk about the money measurement concept. This concept I have already discussed in the lesson 1 also. It means only transactions and events that can be expressed in money terms, in rupees terms for Sri Lanka, then only we can record it in the books of accounts. There are some things that have value, let's say experience of the manager, our brand value, but we cannot reliably measure that in rupees terms, so we cannot record that. Employees loyalty, our management expertise, our company location, right? So we cannot record as an asset. So only transaction and events that can be measured in monetary terms, only in terms of money, if we reliably, not just if we reliably measure that, then only we can record it as a record in the accounting records. That is money measurement concept. So this concept has some weaknesses also, my dears, right? What are the weaknesses it has? The value of money is considered to be stable in this concept. right? We are considering the value of money is not going to lose, but in practice, it will lose. Let's say, my dears, you bought some inventory for 50,000. You actually can measure that in terms of money. Okay, the purchase is 50,000 worth of goods. You are recording in 50,000, but let's say in the market, there is so much of supply and the demand is not increased. So the price is going to reduce automatically. If there, let's say if there is more vegetables in the market, no one is going to buy, the demand is same. Somehow they have to sell the vegetables in the market, so automatically they have to reduce the price. So let's say for 100 rupees, you can buy 500 gram. Now for the 100 rupees, sometimes you buy only 100 gram. Sometimes you will buy 1 kg. So the value of the money in terms of purchasing power, it will reduce and increase according to the market demand and supply. You will learn about demand and supply in detailed manner in economics, right? So the value of money is considered to be stable, but actually the purchasing power, that is the value of money. Sometimes for 1,000 rupees we can buy 5 apples. Sometimes for 1,000 rupees actually we can buy only 2 apples if the price is increasing. So the value of money is not stable in practical, but in money measurement concept we are considering the value of money and we are ignoring the inflation. It means the prices are increasing day by day. We are ignoring that inflation. That's a weakness of this concept, money measurement concept. As well as the items that cannot be measured in monetary terms. Let's say our employees are very skilled. They know our procedures very well. As well as our management is very high capacity people. Our owner skills, their capacity, their knowledge about the business is high. We cannot measure that in terms of money reliability. So we cannot categorize that as an asset. So that's a weakness of money measurement concept. Let's say where we are applying this money measurement concept, all accounting items are measured in monetary terms. We are only providing accounting records, debit record, credit record, everything only for the monetary units items. The values of all transactions are stated in money. For Sri Lanka, all the financial statements we will prepare in rupees thousands, rupees millions. So all the transactions are valued in states of money, as well as the items that cannot be measured in monetary terms are not recorded because we are following this money measurement concept in accounting. Right? I hope so. You got the weaknesses as well as the idea of this money measurement concept very well. Right? So let me tell you one example. Let's say Safia, okay? Safia runs a successful coaching center in Colombo. She has excellent teachers, the lecture panel, a great reputation for his coaching center, a wonderful student relationship with them. But she cannot record the teachers' quality, the reputation of their institute, the student loyalty as an asset because this cannot be reliability. I'm telling you, reliability we cannot measure in terms of rupees. However, when she buys some projectors, the projector monitor for some physical classes, for let's say for 100,000, computers for 300,000, and she pays rupees 200,000 for the website development. All these are recorded because they have a clear monetary values. We can reliably measure that. So that is money measurement concept. I hope so you got the very good understanding right now. And let's talk about the matching concept now. What this means by matching concept, my dears? Simply, the expenses we are incurring should be matched with the revenues that is helped to generate in the same accounting period. It means, my dears, let's say you are recording the sales value of 500,000 worth of goods, right? That's as a revenue. At the same time, that is a revenue. You are recording, okay, I made a sales of 500,000. Same times to earn that 500,000, you purchase the particular worth of goods for 400,000. So your cost of goods sold is 400,000. Now you are matching the revenue 500,000, but you pay to the supplier 400,000, and as a gross profit, you will make 100,000 rupees. That is matching concept, right? You have to record the expenses as well as to make that revenue. You are incurring the expenses. No, if you are recognizing the revenue, you have to provide the expenses for that revenue also. So this will give you a true profit or loss, right? when we are comparing the cost as well as the revenue itself, right? Right. So let's talk about matching concept. Okay, Zaid, you didn't understand the matching concept. Okay, let me give you some examples and more understanding, then you can get it, right? So let's see the definition now. The matching concept dictates that expenses incurred, right? The expenses incurred to generate revenue must be okay, must be compared with the revenue they generated in the same accounting period, right? So let me tell you some examples and applications, right? Let's say one practical example. Let's say, my dear Rashid, okay? Rashid runs a boutique in Kanti. In December, let's say in December, he bought dresses for rupees 500,000. 500,000, okay? He sold the dresses worth of 300,000 in the same December month, right? Worth of 300,000 for 450,000. So let me give you, the actual Excel based understanding, right? So you can get a proper idea now, right? So let's say, right, in December period, I'm going to give you an example. Okay, in December period, he bought dresses of rupees 500,000, right? Let's say sold, he sold dresses worth of rupees 300,000. Worth means the actual cost incurred for us, right? In December for rupees 450,000. Now, can you tell me how much profit he put? How much profit, my dears? 300,000 worth of goods she sold. 4 rupees 450,000 means how much the profit is there? I need answer. Simple answer I'm asking. In December period, he bought dresses around 500,000. So in the December, he sold 450,000, but it's actually only 300,000 worth of goods. So how much he made the profit? It's 150,000 also, no? As well as how much he didn't sold? The closing inventory. It means he didn't sell, he didn't sell 500,000 he bought, 300,000 worth of goods she sold. So 200,000 still as a closing inventory. Closing inventory simply not sold items. Did you understand the concept? 500,000 is our total purchase. From the total purchase, right? Let's say, technically, I'm classifying here. The total purchase he made is equal to 500,000. Out of that, the sales he made is for 450,000, as well as the cost for that sales is equal to, for that revenue 450,000, it incurred rupees 300,000 cost, right? So now when we are preparing the income statement, my dears, let's say if we are preparing the income statement, just for the sake of example here, you know you will mention your sales revenue and you will remove the cost of sales from that particular revenue, and you will end up with gross profit, right? So if I'm going to consider you, right, to prepare the revenue, right, I'm asking you how much students I have to recognize as a revenue here, as a sales revenue. How much the revenue I have to put into the income statement? I'm asking a very simple question. I need answer, right? This is a simple basic income statement. How much revenue I have to record it here? right? How much? Is it total purchase 500,000 or sales 450,000 or cost of sales 300,000? Which value I have to recognize as a sales revenue in the income statement? What's the value I have to? Are you guys understanding or not? Please say the amount in the chat, right? So, my dears, always the total purchase is not our revenue, no. Total purchase is not our revenue, my dears. We just purchased some goods, some items, right? That's worth of 500,000. This is equal to our cost. This is our cost, no. But we made a sales for 50,000. That is actually our revenue, my dear, right? From this 450,000, we add a profit. This is, the cost plus profit is equal to sales, no? The price for 50,000, actually there are worth of amount of goods, as well as we made some profit. We incurred and we added some profit, then only we can sell it. That's business, no? That's basic business. So 450,000. To get this revenue 450,000, we incurred a cost. It means 300,000 worth of goods we sold for rupees 450,000. So the cost of sales is going to be 300,000 for us, right? So what's the meaning of this, my dear? Actually what I'm trying to tell is here, if we are realizing the income, right? This is our income. We are matching that income 450,000 with our expense, that is the main expense, cost of sales. Then only we can give a correct profit figure of 150,000. So it means for 450,000 worth of sales, our worth of expenses 300,000. So we made 150,000. As well as in the financial position, my dears, right? In the financial position, we will say under the current assets category, right? So the inventory worth of rupees 200,000 still we didn't sell. So that is an asset, that is not an income. Until we sell this inventory, it will be in an inventory, it will be an asset. When we sell this, the amount with the profit, it will become a revenue, and the amount it will, convert as a cost of sale. So simply, we have to incur some cost to make this revenue. So we are matching that and we are calculating the profit. As well as, let's say, there are some expenses also, right? To get this revenue 500,000, let's say get this revenue 450,000, not only the 300,000, the direct cost, the direct payment of to the suppliers. We did some advertising, sometimes we did some distribution, right, of wind. So we have some depreciation, it is incurred, right? We made some telephone charges. There are a lot of expenses now. So let's say it's around 10,000 advertising, 20,000 depreciation for our van usage, 30,000 as a telephone bill. We called to the customers and we explained our product. Then only we made a sale. So to get that 450,000 revenue, not only the direct cost 300,000, actually we incurred the 60,000. So that also we have to match with the revenue. So actually the profit is going to be 90,000. So what we are doing here, we are matching the expenses incurred, that is the expenses of advertising, depreciation and telephone charges, as well as the main expense 300,000 against the revenue we made 450,000. So we are actually comparing the revenue 450,000, but to earn that revenue we incurred 300,000 as a direct cost, as well as some other cost. Then only we made a profit 90,000. This is matching concept. We are matching the income with the expenses to calculate the profit. That's how we have to do the accounting. That is matching concept. So the matching concept states that The expenses incurred to generate the revenue must be compared with the revenue they generated in the same accounting period. That's what, even though we made a 500,000 worth of goods, still we didn't sell the 200,000 worth of goods. We are not recognizing as a sales, no. Only the sales we incurred for this period is 450,000 only. So for that 450,000, we incurred 300,000 worth of good purchase and versus 60,000 worth of other expenses. So we are matching for that particular period revenue what kind of expenses we made. You got that, right? So your revenue for that particular period should be matched with the expenses it incurred to generate that revenue. That's the concept. Did you understand, Zaid? We are usually preparing all the income statements with that concept only. We have to realize only that particular period of income, particular year income with a particular year expenses. You know this concept, accrual concept, right? So what's this accrual concept is saying? We have to record the income and expenses only relevant to that particular year. Like that here also, matching concept, you have to record only the relevant revenue and you have to match and you have to record all the expenses incurred for that particular revenue. Because if you have a best product without marketing, how do you sell that? So just purchasing a goods, that's not only the cost. You have to distribute it, you have to market it, you have to pay the salaries, you have to pay the telephone bill, you have to pay the electricity bill. So these all incurred for that particular year period revenue generation, right? That is that. So there are a lot of applications are here, right? Let's say we are adjusting for closing inventories, right? We will learn about this later. So we will adjust closing inventories. Why? Because we didn't sell that. As I said earlier, we are not going to record this 500,000 as a sales revenue. We are adjusting the cost of sales by not including this 200,000 that's worth of closing inventory we didn't sell, and we record that as a closing inventory because we are following this concept called matching concept, because we didn't sell the particular assets, right? That's what it is, closing inventory. So if we are not going to sell that assets, or if we didn't sell the assets or the inventory, how can we record it as an revenue? No, right? So we are adjusting for closing inventories because of this concept. And we are recognizing the depreciation as an expense in the income statement because of this concept, matching concept, because you are using the particular assets for this particular period, for particular year. So you are generating income from that asset, so you have to record the expenses, that depreciation for that particular year also, no? As well as we are providing for doubtful debts or writing off the bad debts also, because you made a sale or credit sale for that particular period. If there is a bad debt expenses, you have to provide that particular year. All right. And we are comparing the cost of sales with the sales income, as I did now. And we are calculating the gross profit according to the matching concept. As well as we are writing off the assets that will not generate future economic benefits. If there are some assets, it's not contributing to the revenue it's generating now, we have to remove that assets, right? As well as we are making some adjustments when preparing some financial statements because of this concept, and we are adjusting for provisions in the income statement because we have to do some matching concept. So if you are recognizing the income, you must recognize the expenses for that particular period income. That is matching concept. Did you understand now? When we are doing more questions, my dears, I will tell you. So this is the way we are doing matching concept application. But conceptually, you have to understand now. Got it? Right? So the closing inventory, actually, we will match with a next month sale, because next month or next year only we are going to sell. Then only we can recognize the cost of sales. Right? That is matching concept. And let's talk about the revenue recognition concept, my dear. So the revenue recognition concept, in the sense, this is simply, your revenue is recorded when it is truly earned. When it's truly earned mean what? If it is a good, you must deliver to the customers. If it is a service business, you have performed your duty, your service is done. So the revenue is recorded when it's truly earned, not when the cash is received. For goods, as I mentioned earlier, revenue earned when ownership, the risk, and the reward is transferred to the buyer. It means you delivered the goods. For services, the revenue is earned when the service is completed. You have done your job. That is revenue recognition concept, my dear. So this concept states that the revenue recognized in the period is truly earned. The word earned is very important. It's not about cash received or not. It's about you have performed your duty by delivering the goods or performing the service. So revenue from the sale of goods is recognized when the entities transfer the significant risk and rewards and control. It means the control is with the customer now. The risk is with the customer now. The reward, it means the benefits from the goods is with the customers. Now only we are recognizing the revenue from the physical goods business. As well as income from the service is recognized when the services are rendered. It means when you have performed, when you provided all your services, right? Then only you can recognize whether you receive the cash or not, you can realize. So let's say an example for the revenue recognition concept, my dear. Let's say Zainab. So Zainab runs a furniture shop in Colombo. Let's say on December 20th, a customer pays rupees 50,000 advance for a custom sofa that is to be delivered in January, but receiving the money in December 20th. So Zainab doesn't record this as a December sales revenue now. She should record it as a liability because advance received in accrual concept, we say there's an pre-received income. That is a liability actually. But on January 15th, let's say, when she delivered that particular sofa and customer takes it home, now she can record that 50,000 as a sales revenue in January month. Because when the risk and the reward is transferred to the customer now. However, if she had delivered the furniture on the credit on December 20th, it said she would record the sales revenue in the December, right? Even without receiving the cash. That is revenue recognition concept, my dears. Right? I hope so you got the point. So the applications are very simple. The revenue is not recognized when goods sent to the dealer on a sell or return basis. As I mentioned earlier, if you are selling or if you are sending just on the basis sell or return, but still we are the owner, we are just transferring the location only, as I mentioned earlier in the session. We are just giving the goods, please keep it with your possession. Still, I am the owner. If you sell to the outside people, then I will record the sale. We cannot record just the transfer of the good as a sale. So revenue is not recognized when the goods are sent to a dealer on a sales or return basis because we are following this concept. Revenue is recognized only we sell the goods to the outside people, not just transferring the sales to other people. Still, the risk and reward is with the owner, right? So that's why we are not recognizing the sales or return basis goods transfership. As well as the credit sales. Even we didn't receive the money from the person, the credit sales still recognized as an income. Sales income, we are recording as a sales income, still we are not receiving any money. Even though the cash not yet received because of the revenue recognition concept. As well as when we are receiving advance received for sales are not recognized as an income. Advance received for the sales because even though we receive the money, we still not yet performed or the delivered our goods, we cannot record as a income because still the risk and reward is with us. So that's how this revenue recognition concept work. Did you understand very well about this? Right? That is revenue recognition concept. Okay, you got the point, my dears? Right? All of you understood this concept, my dears? Okay, Riha Shada, there's a question. When will you send the... Okay, my dears, you will get the books very soon. Okay. Uh, I will inform it, okay? I will inform it. No worries about the books. I will take care of it. Okay, the summary is, my dear, is very simple. The revenue is recognized when you earn the revenue. Earn means If it is a good business, it means physical goods business, you have to deliver that goods to the customers. That is recognition point. When it is a service performance business, actually you rented, it means you have provided the service to the business, to the customers. Then only you can recognize. For that service, you may receive the cash or not yet. You can recognize as an income. As for that particular expense, you paid the expense or not yet. You have to record it as a expenses. So revenue recognition concept, it's saying when you have to record the revenue. If it is a service business, you have performed your duty, you have rendered your service. It means if the education means I have performed my lectures, then only I can realize the income. Even if you don't pay the money yet and I have finished all the things, I record as an income. I don't wait for the what do you call the receipt of the class fees, right? That is revenue recognition concept. We are not caring about cash paid or not, or cash received or not. Especially in revenue recognition, we are not caring about the payment. It means whether we have received the amount, we have received the money or not, we are not caring. We are caring only whether we have delivered the goods to the customers or service. Then you can record it as an income. We don't need to wait for the receivable of the money. That's the summary. You got the point, right? And now let's talk about an important concept, that is materiality concept, my dears. So materiality concept, what this means by materiality? So my dears, there is a special definition that the information is material if it's omission. You have to remember this, okay, definition. If it is omission means completely we are ignoring. Omission or misstatements means we are manipulating the information. Let's say 100,000, but we are recording as a 10,000 only. That is manipulating or misstatement. Or the omission or the misstatements, it could influence the decisions. The word is important, is influence the decisions of the users. The materiality of an item determines. That is material. It means, let's say, you know, I'm saying, oh, I'm hiding something, or I'm misstating something. Because of that misstatement or because of that hiding, you don't know the full picture of something I'm saying. So you are taking some decisions. But if you know that particular information correctly, you will take another decision. So for that particular information, if it has the capability to change your decisions, if we hide that information, or if we hide that, deliberately, if we misstated that, that information is called material, right? If we say that information, or if you know that particular information, you will change your decision. That is materiality, my dears, right? Important items, it needs some special treatment, some special disclosure, while some insignificant items, we can treat it more simply. Let's say, in practical example for you, let's say Ismail, right? Ismail runs a very large textile factory in Jaffna, let's say Jaffna, and that factory worth around 50 million, right? 50 million rupees, the factory worth. Now he buys, let's say, some simple stapler for rupees 1,500 rupees. Even though, my dears, technically a stapler is an equipment, no? We can use the stapler for more than 1 year of period of time. We can receive economic benefits more than 12 months period. It is in the control of the business. It is it is a present economic resource because of the past event. It has all the characteristic to receive the non-current assets. But it is 1,500 rupees, my dears. The factory is worth of 50 million. Even though technically a stapler is an equipment, as an non-current asset, as a property, plant and equipment, it is immaterial relative to the factory size of 50 million, 1,500, we cannot record it as an asset. So we simply record it as a stationary expenses. It is a very simpler treatment. We give it as an expense, not an asset. That is materiality concept. Compared to the 50 million worth of factory, 1,500 is a simple amount. But we are not going to consider the materiality only in terms of money worth. Let's say the factory accountant. right? The factory accountant takes a loan just rupees 5,000. This is material now. Even though the factory size is 50 million, the factory accountant takes a loan just 5,000. In terms of money, it is immaterial, but this is material because of its nature. If we are going to ignore this 5,000, sometimes he can take the 5 million and he can hide it. So because of the nature, it's a related party transaction with an employee. We will learn about this related party transaction things in the later financial reporting sections in level 3. So because of the nature, it must be disclosed in the financial statements, even though the amount is very small. So you have to know that not only we are considering the money value, still we are going to consider the nature to provide it is material or immaterial. So materiality, it's 90% of the time we are considering in the money value, but still in some special cases, it's not about money, it's about the nature of the transaction. So the application is, as I said earlier, a stapler bought for rupees 1,200 is expensed in the income statement. Even though it is fulfilling all the criteria for the assets, we are still expensed in the financials income statement, considering the transaction is of a recurrent nature. It will again and again, it will come, right? But let's say a loan of rupees 1,000 given to a director, right? Just 1,000 rupees, but still we have to disclose. We have to put it in the financial statements. Although the value is small, the nature of the transaction is material. So in the stapler cases, my dears, we are considering the money value to determine the materiality, but in the director's loan, we are considering the nature of the transaction to determine the materiality. So that is materiality concept. Anyone having any questions of this materiality concept? If you have any questions, please let me know. Right. So let's talk about the historical concept, my dears. Let's talk about the historical concept, the next topic, what this means. In accounting, the assets, right, the present economic resources, the assets are always recorded at their original purchase cost. It means historical cost, not with the current market value. This makes the accounting objective, that is verifiable, enhancing qualitative characteristic verifiable. Because the cost is based on the actual transaction evidence. Sometimes it happened before 10 years time, right? So this concept states that, my dears, assets are recorded based on the cost of their acquisition. It might be, it happened before 20 years, 50 years, but we are recording the assets based on the cost of their acquisition. Materiality concept means we must record it. No, not like that. Materiality concept means you have to identify which is material, which is not material. Right? So that is materiality concept. It's not about recording. It's about we have to understand whether it's material or not. If there is a material, somehow you have to record it, or sometimes you have to disclose it. Disclose means you have to provide it as a notes, right? But it has some weaknesses also, this historical concept, my dears. Let's say, I'll tell you one example before we move to the weakness. Let's say Muhammad bought some land in Colombo. Let's say it is in 2010, right? 2010. Let's say for rupees 2 million rupees. For his hardware business, he bought a land in Colombo in 2010 for 2 million rupees. But in 2025, the same land is worth 15 million. Imagine 2 million to 15 million due to the property price increases. However, in the accounting books, under the non-current assets, the land is still recorded at rupees 2 million. That is historical cost. That is historical cost. So now you can understand the weakness very clearly, my dears. Financial statements do not carry the current market values of the business assets, because we are still recording that assets in the historical cost, right? That's a weakness, right? So the application, the property plant and equipments are measured initially at cost. I'm talking about initially, okay? In the beginning, as well as in the cost account, always it is with the purchased cost or the acquired cost. That's the application, right? We will do. But there are some exceptional cases also. Sometimes you will revalue. There's a concept called revaluation also. Sometimes businesses will do, right? So property plant and equipment can be measured at revaluation values, right? It means we will revalue the items, right? In 2025, what is the current market price? And you can record it in the revaluation values, but you are not following the historical concept there. That's an exceptional cases. As well as sometimes the goods can be recorded at their net realizable value. As I mentioned earlier, NRV value. Let's say you purchase for 10,000 rupees, but the worth of the goods is only 7,000 rupees. You can see in the picture clearly, my dears. When you are purchased, the purchase cost is 10,000, but you can sell because of the demand and supply only for the 7,000 rupees. So now you have to record the goods in the net realizable value, that is LKS2 is prescribing. Or otherwise you have to follow the prudent concept, right? So those are the situations where we will ignore this historical concept and we will follow the prudence, right? So that is historical cost concept. You know very well about this now. And let's talk about the disclosure concept. What the meaning of the disclosure concept? Simply, my dears, disclosure means you have to tell very important everything. It means all the important information, all the material information that could affect the user's decisions must be disclosed. Disclosed means it should be revealed in the financial statements, right? Nothing significant should be hidden. Every significant items, important items, we have to give it as a notes or we have to record it as in the financial statement. So the concept states that all the material information, I'm going to highlight the very important word here, that is all the material information. That's an important word here. Important. Right? All the material information relevant to the decision making must be disclosed, right? Revealed in the financial statement without any omission. You cannot ignore any important items, right? Right? So the application is very simple. There are a lot of places we are, making these applications. The first place is we are presenting the property plan and equipment in 3 columns, right? When we are preparing the property plan and equipment, you will understand. I will prepare the financial position, right? When we are doing questions, we will have cost column as well as accumulated depreciation column as well as net book value. Because of we have to show, right, the disclosure, how much the cost is, how much the accumulated depreciation, what is the net book value. As well as we will disclose some events that occur after the reporting period. There are some events we have to disclose it in the notes area because of this disclosure concept. And we will disclose some information as a notes that is not presented in the face of the financial statements. That is must. Let's say some real life examples, my dears, where we are following that. Let's say Aisha, right? Aisha runs, let's say, a dialogue franchise in Goal area. In her statement of financial position, she doesn't just show, okay, equipment 500,000, but she provides full disclosure showing, okay, the equipment cost is 800,000. It means our historical cost is 800,000. And there is a accumulated depreciation, we have reduced 300,000. So until that, we have used that equipment worth of 800,000 and it lost the value of rupees 300,000 for the years we have used. So the net book value is 500,000 rupees only. So that is disclosure concept. She's providing every information that is material for the user's decision making. As well as she also discloses in the notes area, because in the financial statements, the components of financial statement is income statement, financial position, cash flow, changes in equity. There is another component that is notes. So she also disclosed in the notes, okay, there is a court case that is pending for rupees 100,000 from a customer dispute. There is a warranty problem. The customer filed a cash in the customer filed a court case. So sometimes we have to pay 100,000 as a compensation. So she discloses in the notes. Even though this is not recorded in the main statements, she didn't record it as an expense or she didn't provide as a provision, but still she's providing in the notes. That is disclosure concept, because that is very important to take the decision now. So this will give the user very complete information to make some informed decision. That is about this disclosure concept. We have to provide all the material important information to the users. Even if it is not in the numbers, we have to provide it in the notes. And let's talk about the final concept, that is substance over form concept. What this means, my dears? Actually, the substance word means it is commercial reality. It means the transactions, every transaction should be recorded based on their economic reality. The word substance means economic reality rather than just their legal form. We are not 100% following the legal. As I mentioned earlier also, my dears, legally, sole proprietors, owners are same as the business. But in the accounting point of view, we are following the economic reality, that is, owners are separate from the business. As well as, I have explained to previously, I hope so, we can record the leased assets as an assets in the financial position, even though we are not the legal owner. Until we pay all the installments amounts, we are not the legal owner. The deed is with our leasing company's name, the vehicle deed is with the leasing company's name, but still we can classify as a leased assets in our financial position. Why? We are not caring about the legality there. We are caring about the economic legality, because we are having the control. We are using that particular assets. We are making the income, right? That is the economic reality. It is our asset. So in some cases, we are not caring about the legality, but the economic reality. That is substance over form. So form means actually the legality. Substance means the economic reality. So the transactions are accounted for and presented in accordance with their economic substance and the reality, not merely their legal form. We are not caring about the legal form, but we are caring about the economic substance or what it is in the reality. So let's say some application here. An asset held under the lease agreement is recorded as an asset of the business if the business takes on the economic benefits. If the business is taking the economic benefits and the risk as well as the asset is in the control of the business, even though you are not the legal owner, you can classify as your assets. Right? Let me tell you one practical example. Let's say Hassan's having a transport company in Colombo. So he's signing a lease agreement for a bus. Let's say it's worth of rupees 5 million rupees. Legally, the bus belongs to the leasing company until you paid all the leasing amount. But the leasing agreement means Hassan will pay, let's say, installments for 7 years. After that, the business become the owner. But according to the lease agreement, the bus becomes his and he bears all the risk and getting all the benefits of the ownership. But following the substance over form, Hassan records the bus as his asset in the 5 million rupees and the lease obligation as the liability. Even though legally he doesn't own it, it shows the economic reality. No, he is effectively the owner. No. So that is substance over form, my dear. So that is the concept. Some cases we are not caring about the legality, but we are caring about the economic reality. So I hope so. I did a good job in covering all the accounting concepts. So my dears, I have covered all the learning outcomes, but we have to do the past papers to apply our learning in effects, right? It means to apply the effects of business transaction, apply the double entry systems. We have to do the questions, but theoretically, I have explained all the accounting concepts also. In theoretical form, I have completed the chapter 2. We have to do the questions from this chapter 1 and chapter 2. Then it will make more sense to move to chapter 3. Without doing the questions from chapter 1 and chapter 2, you will get frustrated and you are not going to fresh up your knowledge. Then it will be a problem, right? So that's it. That's it for today's session, my dears. So let's see all of you in the next session. Have a great day. The next session, hopefully, it will be the past paper sessions. Do not miss it. Please join it. Okay. So let's see all of you in the next session. Have a great day. Thank you. Bye.